Okay, hi everyone. Going to be the second video here for chapter 12, right? Last time we were talking about equity-based compensation, right? So we said that, hey, you can pay your employees cash. That's one thing. You can compensate them through some type of equity, right? We're going to give you stock. And then we'll also see potentially one way you could compensate them less common would be like fringe benefits on there. So the rest of this lecture, right, we're going to look at the remaining equity-based compensation, namely restricted stock, whether it's just traditional restricted stock or the employee makes the 83B election, and then restricted stock units, and then we'll talk a little bit about fringe benefits. Again, the overarching framework here for all of these items, if there's two things you need to know for the exam, when does the employee claim the income and when does the employer get the deduction for that as compensation expense? Specifically, right, with equity-based compensation. So we looked at the non-qualified options, right, when the income is for the employee on the exercise date. We looked at ISOs when the income is for the employee on the sale date. And then we said, hey, from the employer's point of view, right, they get the deduction for the non-qualified option on the exercise date. And assuming it's a traditional ISO and a qualifying disposition, they miss out, right? They get nothing there. For book purposes, right, they just amortize it kind of even Steven over the vesting date on there. And that was kind of the, where we ended last lecture. Now we're going to pick up with restricted stock, right? So our kind of employee in this case is Elaine, right? The idea here with restricted stock is it's actual stock in the present. Here you go, here's some stock, right? It's not an option like we'll let you buy it in the future at the price set today. Now, one of the things you do have to be aware of is while the employee owns the shares as soon as they're granted, they can't actually sell them until the vesting date. So they have to get that ownership there in the vesting date on it. So there's a little visual there, right? So the question, right, becomes, as we've been looking at, well, like when is it income to them? So the idea here is the employees are going to be taxed as ordinary income for the fair market value on the vesting date, right? Whenever any restrictions on that lapse. Their basis in that stock, again, is going to be the fair market value. So we see here, hey, we're looking at restricted stock on the vesting date. They're going to have ordinary income for the fair market value. That's also going to be their basis in it. So let's look here at 1213 and 1214. Okay, they give us some information. They said there's restricted stock. It looks like, on the vesting date over here, it's worth $10, right? So 10,000 shares in that case times $10. Hey, Elaine's going to have $100,000 of income on there. Similar thing, right? They just changed the fact set there to $3. Again, the overall idea here is on the vesting date is when we're going to have the income for the restricted stock based on the fair market value of that stock. That is when the employee will have the income on there. So one of the things with restricted stock, right, is it is possible for the employee receiving it to make an 83B election, right? And this 83B election, right, so we kind of have Susie here, so it kind of looks like Elaine, but it's a different character, theoretically. The idea with this is we're going to speed up whenever it's taxable. In other words, it's going to be taxable more now on the front end, right, on the grant date for the fair market value. So why might you do this, right? What it has here, right? It might make sense to accelerate the income if stock is worth a low value on the grant date. We expect it to increase in value over time. So it's one of these kind of like playing the market type things. Is it better now to pay the tax and then later on we'll get kind of the benefits from now, or should we wait until later on to pay that tax? But the idea here with the 83B election is, hey, for the employee, it's going to be taxable income on the grant date for the fair market value on there. When we're talking about the corporation's point of view, right, they're generally going to deduct, when we're talking about restricted stock, compensation expense for the fair market value at the same time the employee claims the income, right? There's kind of like an overall like matching, right? That's kind of the general rule. We try to match whenever the employee claims the income, the corporation will get the deduction for it. So the idea with this is, right, oh, okay, well, with regard to the traditional restricted stock with Elaine, right, she claims the income on the vesting date, so the corporation is going to get the deduction on the vesting date. But if it was Susie, right, we have the 83B election, she's going to, accelerate that income on the grant date, and then to match that, right, we're going to have the employer deduction on the grant date as well. All right, the last kind of equity compensation we're going to talk about are restricted stock units. So like right off the bat, this is different from restricted stock. So restricted stock is one thing, a separate thing would be an RSU, right? And when we talk about RSUs, right, they're not actually stock in itself. In other words, like if your employer were to give you an RSU, what they're saying is, here is a promise, right? That's what we're giving you, is a promise that will give you stock in the future, right? So one of the things, right, with an RSU, you only own the stock when it vests, and it doesn't provide any voting rights or dividends until they vest, right? There's no 83B election for RSUs. But the overall idea here with it is, hey, we're going to promise to give you stock in the future. That's an RSU. You're going to, Frank, the employee who gets it, have ordinary income on the vesting date for the fair market value of that. And then the corporation is we're going to try to match that, right? In the sense that, oh, they have income on the vesting date, we're going to get the deduction on the vesting date, right? So when we're talking about RSUs, income on the vesting date for the fair market value to the employee, to match that, right, the deduction is on the vesting date for the corporation. So these are good kind of summary slides. If you would memorize these for the exam, I think that would be really helpful, right? At least from the corporation's point of view, the overall idea, right, we said is to match, right? That's going to be the general rule, right? So non-qualified options, income on the exercise date to the employee, deduction on the exercise date to the employer. Restricted stock, income on the vesting date to the employee. The idea with that accordingly would be, deduction on the vesting date to the employer. Similar thing there for RSUs on the timing. 83B election, again, we match the income on the grant date to the deduction. The exception, right, the only time we have the exception is when it's an ISO, right? With an ISO, they would have the employee the income on the sale date, but we wouldn't get a tax deduction for that on the 1120. So this is kind of the corporation's point of view when they get the deduction. Here's when the employees claim the income. If you were to like graph that over, lay these on top of each other, they would pretty much be the exact same thing, except for the difference here on the ISO, right? We claim the income here on the sale date for the ISO, but there is no employer deduction. All right, so we talked about cash, right, as a way that we could compensate our employees. We talked about equity as a way we could compensate our employees. Now, the third item is going to be fringe benefits, right? In other words, this is going to be non-cash benefits. And as a general rule, right, they're going to be taxable income to the employee. So things that you might think of like fringe benefits, a below market loan from your employer. Oh, hey, the going rate is 10%. We're going to charge you 1% on a loan. We'll pay for your gym membership. We'll give you season tickets to the football team, right? We'll give you money or buy you a car for in your everyday life. We will pay your moving expenses on it, right? The idea with this is it's like they're giving you something. You're going to, as a general rule, have to claim that as income on there, right? So if we look at 1217, right? So there's some examples here for the restricted stock, right? They're showing you, it's fair market value on the vesting date is when their income. They then talk about, okay, that's, the basis as well if they go to sell it, right? So that's restricted stock. They then have the 83B election and they kind of compare and contrast. You can read through there, but when you run the numbers, right, if you were to read this carefully, and do read it, in this specific fact set, right, if we look over a 3-year period, it's going to be $4,500 better by virtue of making the 83B election will have less income that we claim given that particular fact set. But you can read through that, compare and contrast on there. But in any event, right, we're talking about fringe benefits, right? Here's the idea with it. Let's say that you buy a car, right? Okay, you buy it $45,000 and your employer is like, look, we will give you $30,000 for a personal car. So you may think, right, well, I bought it for 45, it's 30, that thing cost me 15. Here's the problem, right? This is taxable income to you, right? You're going to owe $7,200 in tax on that. So if you think about it, right, yes, the car, they covered 30, you went and you paid 15 out of pocket, but then when you go do your taxes, you're going to have to pay 7,200. The combo of these two, right, that would be like the total cost of the car to you after you consider the tax implications of that. One of the other things, right, we're going to kind of walk through various fringe benefits. We will see, while the general rule is they're taxable, there's a slew of them that are not taxable. And most of the time, if you're just like an average employee, the ones you're going to experience in your life are going to be non-taxable fringe benefits. But in any event, one of them here is whenever we have an employer that pays premiums on a life insurance policy, the death benefits are going to be tax-free up to $50,000 on there. So you can read through this. I'm not really as concerned with this. But if you look at the fact set, right, there's like, an employer that pays premiums on an insurance policy. It ends up paying out $750,000, right? $50,000 of that we can exclude. In other words, like the taxable amount, we got $50,000 we can back out. So we said, right, generally they're going to be taxable. When that is happening, right, it's taxable, there might be something called a gross up, right? So yeah, we're going to give you $30,000 for the car, right? Whatever the case, we looked at that. Okay, here's 30 grand for your car. By the way, that's going to generate $7K in tax liability, right? So what they will do is they'll gross that up, right? What they'll end up giving you is maybe something like, and they'd have to run the numbers on this, here is 40K, right? After you pay tax on this, right, we're going to give you more so that you can use it to cover the tax liability on there, and then have, after you pay the tax liability, the leftover amount for the car. The other way I've seen a gross up, right, if you ever watch Who Wants to Be a Millionaire, and it's only if they win the million, right, they give them like a big check for like 1.8 million, right? They gross it up such that after they pay tax on it, the person walks away truly with $1 million on there. So that's the idea of a gross up. It basically considers the fact that it's taxable, and we'll just give you the additional money on top to cover that tax. In any event, right, we said generally they're going to be taxable. They could have that gross up to help there. The exception will be non-taxable fringe benefits. Here's kind of the interesting thing with it, right? Most of the time, from the corporation standpoint, whether it's a taxable fringe benefit or non-taxable to the employee, right, to you, most of the time, they're still, as a business, going to get a deduction for that for compensation expense. So we will see this is kind of a good thing. It can create these kind of like mismatches or double dips where you could work together with your employer to take advantage of these. But let's look at some of these, right? So we talked about life insurance, and don't go down that rabbit hole. How about health and accident insurance and benefits? So I don't know, maybe your monthly health insurance at your job is like $400, right? And you pay 150, and the employer would pay 250, right? Like the corporation, and here's you. When they pay that amount, right, the 250, that's a non-taxable fringe benefit to you. Or if they were to reimburse you for medical expenses, so on and so forth. How about meals, right? Well, essentially, you as the employee, right, most of the time you get a meal, you're going to be able to exclude it, right? So one of the things here, meals that are provided on the employer business premises are not going to be taxable. So, hey, there's like a cafeteria on site where they feed you each day. You don't have to claim that as income. If it's for the convenience of the employer, right, which essentially means it helps you perform your jobs, it will not be taxable income. Very typical thing here during busy season. Hey, 3 times a week we're going to order food at 7 p.m. You'll stay until 7 to get the food. You don't have to claim that as income. The most common one, right, is it's just de minimis. Like if you go out to lunch, like when you first start your internship or job, you don't have to claim that as income. Or like periodically you go on a mentoring lunch or they get you coffee. Doesn't rise to the level, not big enough to really kind of focus on that or care about it. How about lodging, right? If your employer gives you lodging, it's like a poorly drawn house, I apologize. Overall, right, as a general rule, right, if they pay things like your moving expenses, or hey, here's an internship, don't worry, we'll pay for your housing, that's going to be taxable. The exception here is whenever the employee can exclude it, right? So the employee can exclude it whenever the lodging is a condition of employment, it's on business premises, and it's for the convenience of the employer. This is typically like the nature of your job requires you to live there, right? So like, oh, you're an apartment manager, right? And they say, hey, you're managing these apartments. We physically need you to live on site to do your job, right? You don't have to include that housing as income. Same with military housing, right? Like we have Jeffrey here from Fresh Prince of Bel Air. He's the butler, like the house kind of person to help out. They give him housing on the show. Well, he doesn't have to claim that as income because it's a condition of employment. It's on business premises and it's for the convenience of the employer. So these are like another one might be like a cemetery person, like a caretaker at a cemetery. The nature of these jobs require you to physically be there, and for that reason, they're going to say this is for the convenience of the employer. The lodging, the housing you get, you do not have to include as income. But this is more of the exception than the general rule. Other ones here are employee educational assistance, right? So you can see roughly up to $5,000 you can exclude from income on this. Typical framework, right? Like maybe your employer offers this benefit, you're doing your MBA, you get like one class a semester, right? You do it, and then the idea with this is okay. Well, this year they paid $5,000 in year one for my tuition. I don't have to include that as income, and I'll get an MBA out of this. So this is like typical, like if you were to work at like a bank or somewhere and you're getting a grad degree, one class at a time. This is leveraged very commonly there. Other one here, dependent care benefits, right? Up to $5,000 a year, paid or reimbursed by the employer, caring for children under the age of 13. So, hey, daycare, stuff like that. One of the things to be aware of here is like, just because we talk about these does not mean that the employer actually is going to offer these. This is like, at the discretion whether they offer it. And if they do offer these items, right, some of them they can discriminate as to who they offer against. Others they have to offer to everybody. Don't memorize that, right? I'm not going to test you on some nitpicky thing like that. But where I'm going with this is like, don't expect this to be at your employer, right? Like, whether you get a match from your employer, some give a match, some don't give a match, right? These are just kind of like the collection of all the things you could get from your employer as a fringe benefit. The next one is no additional cost services, right? So employees can exclude from income the value of any no additional cost services. So this is basically services provided to the employees in the ordinary course of business that generate no substantial cost to the employer. What you might see is, right, like, hey, I'm a stewardess, right? I want to fly standby on a space available basis, right? Okay, here's the plane or whatever. Oh, there's like all these empty seats on it. I'm just going to take that seat. And I take the flight. I don't have to include that as income because it's a no additional cost service. This plane is going to fly anyhow, right? It's there. Just let me sit. Don't have to include it as income. Could be something like internet or telephone service, right? If you look at 1221 there. Another one are qualified employee discounts, right? There's the potential that you can exclude any discounts from income. So if it's goods, right, as long as they do not acquire the goods at a discount greater than the average gross profit percentage for the employer's goods, it's not going to be taxable. So let's look at 1222 here to kind of flesh this out. Oh, sorry, we zoomed in there pretty quick. Okay, let's focus on the desktop, right? The retail price is $1,800. It costs them $1,250, right? So if you were to walk into Best Buy, you'd pay $1,800, but our employee gets a discount of of $500, so they'll pay $1,300. So this is like, fair market value. This is what you pay, and this is what you save, or the discount, right? And this is what it costs Best Buy to buy it. So what you do here is, right, you take the retail price with the gross profit percentage, right? That essentially will give us $450. We then say, oh, okay, 450 is the max we're allowed to exclude from our income. Well, if 450 is the max and we got a discount, we save 500, then accordingly 450 in that case will not be taxable income, but we're going to have to include 50 as income. Compare that here with the laptop, right? Kind of similar framework with the laptop. You run the numbers, right? The max discount is 525. We save 500. There is no income. We haven't really kind of hit that peak yet on there. All right, next one are working condition fringe benefits, right? You can exclude any benefit or reimbursement of a benefit provided by an employer. Typical thing you might see, right? CPE credits. So once you get your CPA license, right, you got to do roughly 40 hours a year of continuing ed, and get CPE credits for that and pay an annual fee. If your employer pays that, for you, that's a working condition fringe benefit. You don't have to include that in income. Another one here are de minimis fringe benefits, right? This is kind of a catch-all in the sense that it's just like, this doesn't rise to the level, right? Like if you take a pen or something from your employer, right, that's de minimis. If you use the printer at your work to print out a birthday invitation or something, a personal use item, de minimis, right? Even though you technically got something, it's not going to rise to the occasion, right? So like occasional tickets. The one time in practice, I got, Penguins tickets on there. I don't have to include that as my income. It was just some partner who sent an email, does anybody want these? Well, I got something, but I don't have to claim it as income. on there. All right, kind of continuing here with this, right? Qualified transportation fringe benefits, right? Employees can exclude from income the value of any qualified transportation fringe benefits up to $300 per month per employee. Typical thing you might see here, right? Like your employer is like, hey, we will pay for your monthly bus pass, your monthly T pass if you take the T in Pittsburgh to work. Or we will pay for parking, right? We will give you an allowance for parking. Up to $300 a month, you don't have to include that as income. Next thing, let's talk a little bit about cafeteria plans, right? So employers can offer either like a standard benefit package, like here's your health insurance, here's your dental, here's your other items. Or alternatively, they can offer a cafeteria plan, often packaged with an FSA, which gives a little bit more flexibility, right? So the idea here with the cafeteria plan is the employer basically kind of says, here's the total cost of benefits that we're willing to provide you, right? Maybe every month we're willing to, buy your benefits or whatever up to $1,000, right? Then what you do, just like a cafeteria, right? If you go to Chipotle, you're like, give me some chicken, give me some rice. Like you pick what you like, right? And like avoid the guac and stuff because they love to charge like $4 for that. But the idea with this is you kind of get to pick on there. So here it is, what we're willing to offer. You pick what you want on there. That's the idea of a cafeteria plan. And when that happens, they often package them with an FSA, which we'll talk about. Now, it is possible under a cafeteria plan, right? This is just like the max on here. Like this is what we're willing to cover. It doesn't mean they're giving you $1,000 cash. That's just kind of like, here you go, this is the max. In the event they actually do give you the cash under the plan, right? Like, here's the cash, go buy your own health insurance, then that is taxable income in there. But in any event, up here, they choose the benefits they desire from non-taxable fringe benefits. So general rule, non-taxable. Exception, when they give you the cash, taxable. Now, we talked a little bit about an FSA, right? What this means is a flexible savings account. And essentially, you get to use pre-tax dollars to pay for medical expenses or for dependent care expenses, right? So pre-tax is good, right? Like, if I put, and the idea here, the annual limit is something like $3,000. Well, if that's pre-tax, I put $3,000 in. If I wanted to spend that same $3,000 on braces for my kid, I may have to, earn $5,000 such that after I pay the tax on it, I have the three. So this is the tax, it's a tax kind of advantaged account. Now here's kind of like, that's the good, right? So I'm going to put like smiley here. That's the good with it. Here's the bad, right? You have to be careful with these. They're use it or lose it during the year. So what might be a setup of an FSA where it makes sense, right? So here's year one, here's year two, right? Typically your employer close to the end of year one will say, hey, do you want to participate in the FSA next year? Either we will fund the FSA as the employer, or you can put into that like $3,000, right? Pre-tax money that you can use for like medical expenses or daycare, okay? So what might be a situation where that makes sense? Well, hey, I know next year that my kid is getting braces. I know next year that I want to get LASIK surgery, right? Some type of medical event that you have like reasonable control over, right? You don't know next year if you're going to like break your arm or something, but some medical procedures you do have a certain degree of control. Or like, hey, I have a 2-year-old kid right here. They're going to be 3 next year. There's a lot of daycare next year I got to pay for on there. So that's kind of the setup with it, like a situation when it would make sense to use an FSA. Now, I told you, like, let's say that you put the $3,000 in there, like, oh, okay, I'm going to use this for my kid to get braces. Then during the year, you get a second opinion, they don't actually need braces, right? What happens is if you don't use it during this year, you can generally kiss that goodbye, right? It's use it or lose it. That's kind of the risk you have on there with it. There is a little exception, right? Like say that we didn't spend a penny of it, right? They do give you like an additional 2.5 months into like year 3 to use it. And like you don't lose all $3,000, right? Like whatever 2,400 or whatever you lose, right? So you get 2.5 additional months, and then you get to carry forward $610. So like roughly 2,400 or 2,390, you could kiss goodbye. In these kind of situations, when you're pushing up against that sort of deadline there, use it or lose it, you would just go like buy things like over-the-counter medication, like there's various things that you can get with an FSA, like contact lens solution potentially. But a lot of times these things happen where it's just like I have this money, I got to burn it, it's use it or lose it on there. Finally here, right? Remember we said that fringe benefits, the general rule is they're taxable to the employee. The exception is, right, they're not taxable. For the corporation, right, regardless of whether they're taxable or not taxable, as a general rule, they're going to get a deduction for them. The upshot of this, when we're talking about non-taxable fringe benefits, right, like Homer is happy because he doesn't have to claim income on that. And Mr. Burns, the corporation, right, he's happy because he still gets a deduction for that. So it's kind of the best of the both worlds on there. Given this setup, right, where like one person doesn't claim it as income and the other gets a deduction for it, this kind of mismatch, there are strategies that you could kind of negotiate with your employer, like theoretically. So let's look here at some of these. So we look at this guy, right? Our employer says, hey, we will pay $5,000 for your MBA this year. The max is $5,250. Hey, all of that we don't have to claim as income, and we have even a little leftover that we could still use for additional tuition on there, right? One of the things here, right, is say that we know that our employer wants to pay for our MBA, right? One of our classes on there, and they're trying to give us, in this case, $5,000 for the MBA for the year, right? There's two ways they could do this if you think about it, right? We have kind of option one is, right? The first thing they could do is they're trying to give us $5,000 on here. They could give us $6,500 just in additional cash, right? And the idea with this is like if they gave us $6,500 in cash, after we pay the tax, right, we'll walk away with $5,000 for our MBA on there. That's from the employee's point of view. From the corporation's point of view, right, they got to pay like $6,500. They're going to get a compensation expense for that they'll save taxes on. So then it'll cost them $5,100 to do this, right? Once you take into account the tax considerations. That's option A or option one. Option two is basically say this, right? Hey, go and purchase your MBA tuition for $5,000 and we will reimburse you, right? So the idea with this is, because it's non-taxable to you, we don't have to give you more. We don't have to gross this up. We'll just give you the $5,000. You don't have to claim income on it. There you go. And then, we'll still get the smiley, the deduction for it from the corporation. We'll get some tax savings. So we gave you $5,000. We still get the tax savings on them. The total cost in this for the corporation is $3,950 for it. So the setup here, right, if you were the corporation, would you rather, one, just give the employer the money, gross it up, there you go? Well, if you do that, it's really like it costs you $5,100 versus if you take advantage of The mismatch, right, where there's like both smileys, the employee doesn't claim it as income, but the employer gets the deduction, it's going to cost you $39.50, which is cheaper on there. That's what this slide is saying here, option 1 versus option 2. You want to pick option 2 because it's going to save you roughly $1,200 to do this. Right? It'll be overall cheaper for the corporation to take advantage of this. So that's the end of this lecture. I'll get this posted and we'll go from there.